All right, let's talk. Let's go back to the market mechanisms and trading. Last time we talked. So when I try to post these videos, I'm going to split them. So I want to split it right about here, so that is the Madoff video, and then now we'll turn back to markets and look at the market mechanisms that we were talking about. We already talked about IPOs and the primary market for bonds mostly. But the same thing goes for stocks. So we have this primary market where, at least with stocks, we don't really know what the company is worth. We're kind of hoping it's worth something. So the company and the investment bank takes the show on the road, and they're basically showing kind of what we think this company is worth. And they're rounding up investors so that the day that the IPO is printed, they have shares. They have people that are buying their shares. So that's the primary market. Then we look at the secondary market, and the secondary market is very important because without it, the next time somebody wants to come to market and raise money, they're not going to be able to. So the investors want to be able to know that they can sell their investments relatively easily without losing market value, or next time they're not going to answer the call. Right? So they need to know that there's a liquid market. And remember, I'm sure in other classes you've come across the definition of liquidity, that there's two components to liquidity. Not only can you sell it fast, but you do it at market. Because everything can sell. Right? There's always a price. It's just whether it's the right price. So as long as you can sell it quickly and you can do it at market, it's a liquid market. That's liquidity. So we've got the secondary market, and we have different ways that they trade. There's types of markets. So we'll just talk for a little bit about that. There's direct search, there's broker, there's dealer, and then there's auction. And you can kind of, I'm sure you can imagine other items that you've seen trade. So you can kind of already mentally form lists of what is good about each of those and what's the limitation for each of those. Direct search just means that the buyer and the seller have to find each other. So it's like you selling your car to your cousin, right? Direct search. What's the benefit of a direct search market, if I put it in the context of the car?
No fees.
No commission. So there's probably still some transaction cost of some sort, because you probably have some kind of tags and all that. There's always a transaction cost, but very low fees, no commissions. What other benefits are there to a direct search market? Possibly, anyway.
Bartering.
You can barter, which may or may not be a benefit to you, right? So you could trade.
I would say
I can almost put it on both sides of that.
I would say that you at least know where your money's at.
You know,
like you know exactly what you're invested in.
Yeah. Yep.
You're doing
so
that.
So it's very clear what the price is, the transaction price. You know what it is. Where when you buy a car from a dealer, you don't actually know what the dealer price is. They tell you it's whatever it is above markup, but you don't know if that's actually true. You know. So here you saw both the buying and the selling price because they were the same price.
You also have the ability probably either to buy or sell either above or below market. Right?
Yeah. So you
could
could
buy something
possibly
at a value, or you might be able to sell something at a premium. Take advantage of the, I guess, lack of knowledge of either the buyer or the seller.
Right. You could be, if you're the knowledgeable investor, then you may have access. You can make possibly more money. You might be able to buy at a lower price or sell at a higher price. Most of us want to sell our car direct so that we can avoid whatever the markup is that we know we're going to lose money if we sell it as a trade-in to the car dealer. So those are good things. We do the same when we sell our houses direct, right? We've kind of determined the price and we're comfortable with it. The negotiating part is not always a benefit because sometimes it's really a lot easier to negotiate through a third party. It kind of removes the emotion from it, and it's a little bit easier to be firm on your price if you don't have to look in the eyeballs of somebody else. Some of you may enjoy the negotiating. I think most of us don't. Many of us don't. We don't actually want to have to do that. So it's nice having representation. The downside of direct search, you can probably think of some, but you may not have been able to exhaust the market. You may not be able to find potential buyers out there or potential sellers because they didn't read your local classifieds, right? So you may not have access, and you are relying on your own expertise. So you don't have the expertise of the advisors that you may have if you were to use somebody else. So you are limited to your own expertise. So we've all done it at some point, I'm sure. You've done something where you've entered the direct search market. Stocks and bonds can trade in a direct search market, no problem. Right? You can buy or sell one party to another. Usually if it's stocks, it's going to be done like in a closely held or family business of some sort where they know the buyer or the seller, they're actually selling to somebody. In bonds, it's probably like dealer to dealer where I want to sell something, so I call the person at Goldman Sachs that I know and I say, hey, listen, you want to buy these from me? So it's a very negotiated kind of market. So that's direct search. Now broker. So these are the pluses and minuses. So that was one. Broker. Now everybody understands the difference between a broker and a dealer? Do you have a sense of what that is? Think about a broker as like a real estate broker. They never owned the item. They simply matched a buyer with a seller, but nowhere in the real estate transaction did the real estate broker take possession of the house in their own name. Right? So that's a broker. And a broker then gets paid a commission. A dealer, on the other hand, actually bought it for themselves and then sold it out of their inventory. So think of a car dealer. Now, car dealers, it seems like they don't own it because it's all financed, but really they took possession of the car and then they sold it. So you are not buying it from whoever they bought it from. You're actually buying it from the dealer. And the difference then is their profit. It's the markup. So they're not getting a commission, they get a markup. Right? So when it comes to a broker, there's some benefits to using a broker. And I've never bought a car from a brokered market, but there is a brokered market for cars. Right? You can get a car broker. They'll find you the car you want. They'll go to various auctions and things and find it. So there's an active broker market, especially if you're in like a high-end luxury car. There's a brokered market for cars. So based on that, what's the benefit of a broker?
Convenience.
What was that?
Convenience.
It is convenient.
Market knowledge.
Yep, there's expertise there.
You're gaining their resources.
Yep. So you gain access to markets.
Or liquidity.
Yep.
Venture to guess their fees are probably lower than a dealer's fees.
Not necessarily.
No?
No, not necessarily. That's actually one of the downsides to both of these. I mean, you're going to pay a fee of some sort.
Yeah.
So you're going to pay a commission. And sometimes those commissions are not really very negotiable. I don't know if in recent years, housing, have you been able to, I bought my house in 2007, the worst possible time to buy property in Wilmington. June of 2007, in fact, right before August. So at the very peak. And so I don't know what it's been like in the market since then because I've been hiding and waiting, waiting. Someday I can get out of my house.
One of the few things that transactional costs have not gone down.
They have
is
not.
Real estate.
They've stayed at that
They
6%.
stayed
Yeah,
at
it's still
6%.
6.
That is unbelievable. Do we have
Yeah.
realtors in the house? Nobody's a realtor? That's just amazing that other are you a realtor?
Only by necessity.
Okay.
I'm not an active broker or anything.
You're not an active broker.
I'm an
You're
active
in the
broker,
business.
but I don't actually do buying and selling. I do analytics.
Okay. But isn't that amazing that that transaction price, I know, we're not going to attack you.
Especially after the 2007 boom.
Yeah, but it stayed that high. It's surprising to me that the market's been able to maintain that. So brokered markets are convenient. They do actually offer you the benefit of having somebody else do the negotiating for you. So you have kind of an advocate. That's here. But they could also lead to a potential conflict of interest. That potential exists. It just depends on how the fees are structured. So if your commissions are based on transaction price, they have every reason to want to see a high transaction price. If their commissions are based on volume,
push you into something you might not otherwise.
right?
Yeah.
So you have to do things to mitigate that risk and things like contracts and so on. So you find ways, or you make it a flat fee, or what have you. So depending on how the compensation's structured, it may lead to potential conflict of interest that you didn't want. So many brokers are paid on trades, right? Trades. So they have every reason to see that you continue trading. Doesn't matter if the prices are going up or down. We just want to see trading. So there's the potential for what's called churning an account, where you just sell Coke, buy Pepsi. Sell Pepsi, buy Coke, right? You're not really doing anybody any favors. You're just generating trades. And so most brokerage houses will have a compliance division that watches that. So we had a compliance officer that watched the volume of trades in and out of certain accounts, and it would kind of raise a flag that there's potential churning going on, so that we could make sure that we weren't violating any kind of ethics. Dealers. So now the dealer, think about it again from the car perspective, and then you can translate that to stocks and bonds. The dealer buys from you when you want to sell, and the dealer sells to you when you want to buy. And the dealer faces a risk. The risk is that the dealer buys from you something that they can't sell. So they have the risk of sitting on inventory that they can't move. Right? And for that risk, they have to be compensated. And so they compensate by bidding at a low price
and selling higher.
and selling high. That's how they have to compensate themselves. So whatever you think the price is, they're always going to bid lower than that. Always. You think the trade-in, you look online nowadays, you can find out what the trade-in's worth. You're not going to get that. You're going to bid it, it's going to be here. And then you want to buy the car, a used car from them. You think you can find it at whatever price, but you're not going to. It's going to be just a little bit higher. That's their markup, and they have to be able to do that. It's actually fair. That's the risk they take. So why the dealer market? What's so good about it?
Access to inventory.
Access to inventory.
Liquidity providers.
What was that?
Liquidity providers.
They do provide liquidity. We're going to try to trade in my husband's Suburban on a different car. He wants a different truck. We could put it in on eBay and whatever. It's a headache. We don't really want to do it. We know that we will get a lower trade-in value by trading it in, and we're going to do it anyway.
Convenient.
What?
Just convenient.
It's just convenient.
Convenient and easy.
It's just convenient. It's okay with us if people make a living, right? Like it's actually okay. And we feel like we kind of know what things are worth nowadays. It's not like in the old days where you really didn't know unless you were in the market itself. So you kind of have a sense of what it's worth. So we are going to use a liquidity provider because they'll be able to pay us on the spot, really, and move it. So this is a good thing. We also have their expertise, just like we would with the broker, right? And we have access to their market. Well, we already said that. We said their inventory. That's good enough. The downside is now sometimes transparency may go away a little bit. You may not know quite what the difference is between the bid and the ask. Depends on the market. You would only know if you bought a car off the lot and immediately tried to sell it back to them. That's the only way you're going to ever know what the true markup is. But otherwise, it's not an entirely transparent market. So you may give up some of that.
And wonder why and I hate car dealers, but wonder why we make, but the financial services business is the same. We have to tell them what we make. You don't know how much money the shoe company made on those shoes you're wearing. Why is it not transparent if we don't know how much a car dealer makes on a car?
Well, it doesn't have to be transparent, but if you're trying to get a sense of whether you're being treated fairly,
right? But
right?
my
That's all it
question
is.
Why do we ask those questions when it comes to cars and when it comes to houses and when it comes to fees on financial services, but we don't ask those same questions when it comes to
buying a dress
that
at
steak we bought or the meal we bought. It's
I think that's
And it might be just high
It may
dollar.
be the dollar, but there are some things
Regulatory
that we
systems.
buy. Well, yeah, we're highly regulated, but
Completely regulated. I mean, everything's
highly
in the HUD
regulated.
statement to the penny.
But
So
it's always just, I've always been offended by the fact that when I was sitting in front of a client, that I had to tell them, and I was asking for their business, I had to tell them how much money, what our fees were, exactly, how much of those fees I was earning, if I was earning any residuals on insurance products or mutual funds, I had to tell them exactly what they were. If I won trips because I reached certain incentives, I had to disclose that. I had to disclose that I may be a partner. I had to, all those things I had to disclose. And if I didn't, I was in violation of the rules, yet their business, nobody else has to do that.
Well, and you were in financial services of some sort? And that, I think, is not the same as necessarily the car dealer market. It's more about the fact that financial services is like the most highly regulated industry, I think, around. And I think that the theory is that if the government is going to protect financial services to that degree, and if financial services is going to be that important to the functioning of our economy, then we're going to regulate the daylights out of it, and we're going to make sure that every little I is dotted and T is crossed. I think it's the industry.
It's regulated through the SEC.
But the fact is, too, I mean, I can come to you with an
them.
I'll feel
investment
much more
plan.
safe.
Right.
I come to you with an investment of my money. If I'm buying a Cadillac or a Chevy, that's a known commodity. I mean, and there's a huge marketplace where I mean, I know I'm getting 4 wheels and a steering wheel, and it's going to be basic transportation. I think most of the world is kind of, sort of blind to what happens once they invest their money. It's like, where does it go? What are these markets? I mean, so there has to be more transparency, just because it's.
Right.
But if the car's not going to break your retirement, an investment might.
Well, but you can also go buy that same investment on Fidelity, it's a website. You can buy it on your own, and they could be, as a dealer, they could be selling it out of their own inventory when you buy it, and you don't know what they made on that either.
So you were brokering.
Well, I was with a broker dealer. Yeah.
You were with a broker dealer. Yeah. So we had to do the same. We had to disclose our commissions on brokered items, but we didn't have to disclose our markup on items that we were dealing.
Oh, we had to disclose our markups as well.
Yeah. I mean, I was in the bond market, so it's
Well, we had to
different.
disclose the markups on bonds, the commission.
The
We
commission.
had to disclose
Yeah, we didn't have to.
fees on fee-based, and we had to disclose full commissions and anything.
But it's strictly the regulation behind. It's the fact that those industries are also protected. The government protects those industries. They don't actually fail like other companies are allowed to fail. We keep talking about this, too big to fail. They have been protected over time. Banks with FDIC insurance, We've propped up all kinds of financial services, and in exchange for that, and because they're so important to the industry, we tie their hands. We sort of tied everybody's hands.
You know, I think part of it too is that you buy a Cadillac or you buy a house, there's an actual known price, right? And part of the problem with financial services is that there's not a stated price. It's not, you are going to pay me $5,000 a year unless you just held yourself out as an RIA and you charge that, right? Otherwise, it's wrapped up in all these different ways with different trails and commissions if they had annuities and whatever else. And I too was with Raymond James, and so we were a broker dealer. And so there's really no clear, transparent way to know as an investor what I'm paying when you're entering those type of agreements, unless it happens to be just a real clean RIA agreement. Yeah. Because there's money flying all over the place from different sources. So I mean, it's a legitimate question. It's just the way the product's presented, there's just not a stated price. Like, I'm going to give this to you, and it will cost you this much a year. That's really kind of what I think I think
that's a good.
Right.
And even then, they don't know exactly how much we make, right? I mean, I don't know what my overhead of my office is, or what my cut on the back is, and there's so much more to that question.
Right.
But which we don't even know, like what, say, Caldwell Banker would make off of the house all after it's all said and done. But we at least know the house cost $300,000.
And we know we paid 6% on that, and we know. But like the mortgage document, you can barely decipher. The actual financial transaction takes. You can't hardly make heads or tails of the financial transaction itself. So I think the dealer markets are a little bit more opaque. You don't always know exactly, unless you were in the market itself, you don't know. So if you're a knowledgeable trader, you can tell, but otherwise it's hard to tell what price they would truly buy at and what price they would truly sell at. Bond markets for years were very opaque outside of the actual dealers who are on the phone. Like, even the dealers, other dealers may not always know what two dealers have bought and sold one another. So I may have bought bonds from former First Union. Well, only I and the trader at First Union, we know the price we agreed on, but we're not advertising that anywhere. So nobody actually knows what price we did it at. And then I may take that and I may buy or sell to somebody else, and unless you were in the room and you overheard me on the phone, you don't actually know what price I sold at. So the rest of you don't know what the market is necessarily. And so you can kind of see that on cars nowadays. Cars today, there's a lot more information public. But unless you, in the old days, unless you went from dealer to dealer, you didn't know what a Honda Accord, what everybody was selling their Honda Accords for. You had to actually go there and find out. There was no public any information. But today with the internet, everything is a lot more transparent. But there's still some degree of opacity. Is that the word, the noun? Lack of transparency. So we've got dealer markets, and then you do have this markup, and it could potentially be high. We don't know. It could be. And then the last one is auction markets. And anybody here enjoy auctions? It's a fun thing. I don't know if you've ever been to an estate sale or an auction. Have you been?
My grandfather loves them.
Yeah.
He
We used to do it all the time. Like Friday nights, where there's an auction house down in Wilmington. We used to go there all the time. Pennsylvania, that's like auction.
They're a rush.
Huh?
I said they're a rush.
They're fun. They're just kind of fun. And you pick up who knows what.
I went to the Barrett-Jackson auction down in Scottsdale, where they auction off the cars.
Oh, okay.
And like, oh my gosh, it was awesome.
So it's crazy.
Yeah, it was a lot of fun.
So the auction market is a legitimate marketplace for you, and there's an auctioneer, right? The auctioneer is the one that brings the buyers and sellers together, and that there's something to be said for the buzz in the room. That's informative. So you are actually seeing live what other people are willing to bid. You're not waiting until a transaction happens for you to know. You got to see all the bids as they were coming up. And then you could see the excitement or the lack of it. And that told you something about, there's information in that. Today, well, it used to be that the New York Stock Exchange was basically an auction market. There's a specialist for every stock. That specialist is the auctioneer. And then people were shouting and carrying on like you saw in the movies. And then little by little, all these markets have gone electronic, and the buzz is gone. And so old-time traders find that to be really disconcerting because there's information that's gone. We've been to many, many auctions, and every now and then we'll be at an auction and we'll discover that the family is present at the auction. So like usually it's an estate sale, and you discover that there's family. And as soon as the family starts bidding on an item, most of us would just back off. Like, you're not going to go up against the family because you're not going to win it, right? Let's say just let them have it. It's theirs and they want it. Because there's no price at which they're willing to stop. If they want grandma's, tea kettle, they're going after it and you're not going to stop them. So just seeing who is bidding is informative. Well, that's gone if there's no auction house anymore. So the benefit of an auction market is some transparency. There's actual information in the noise. The noise is informative. And it's going to lead to, a clearing price. There's going to be a high bid, right? We didn't leave. You're not leaving money on the table because it was right there in front of you. You've got the clearing price. The downside is it's often tied to a location, so it could exclude certain parties who were not there, who missed the auction. So sometimes it's very location specific. Although there are many auction houses where you can call in and you have somebody bidding for you. We had a friend that worked in an auction house, like art and that sort of thing, and that's what you did. You called in your bids. So you've got eBay is an auction house. Like I said, the New York Stock Exchange is basically an auction house. It's just there's an auctioneer and that's the specialist. It's a little bit weird because the auctioneer at the New York Stock Exchange is collecting bids and collecting offers. They're collecting all these. And these, the auctioneer is also able to sell out of his own inventory or buy out of his own inventory. So it kind of muddies the waters a little bit. So he will stand as the buyer if no buyers can be found, and he will stand as the seller if no sellers can be found. So he makes the book match. And that's led to some cries of improprieties in years past.
There's some intrinsic or percentage of intrinsic price fallacy there in terms of the frenzy that can be created at an auction. Maybe just because you get in that room and it's the adrenaline's going and it sells it
ends up going higher,
much higher than it should be.
There's a whole line of research in finance called market microstructure. This is a very quantitative, very detailed area of research. Some of the big schools in that are Cornell and NYU. Market microstructure. And they study whether the mechanism, the trading mechanism, influences the price. And theoretically, it should not, because rational markets, efficient market theory says that what something trades for is what it's worth. Right? And how we trade it shouldn't impact it. It shouldn't impact it. But this whole area of research, and they have all these fancy formulas and everything else. It's a very interesting area of research, but that's what they're investigating, is whether the mechanism affects the actual transaction price.
You can't put a price on winning. And that's not just in this, it's across the board. The reason restaurants are open and don't close people off is because whether you know it or not, when you see somebody else eating, you eat faster. And so it's a whole there's all kinds of stuff tied to that. So an auction, just as you said, you're in there and you're getting pumped, and especially if there's already something you're looking at and somebody else is looking at that same thing. You're throwing those bids up, and there's a certain point where I think a lot of people on anything will overpay just to be able to go, I got it. It was 3 times more than it's worth, but I got it. That guy did not get it.
There's actually the flip side of that then is called the winner's curse, that if you get it, you've now paid too much because you just beat the next highest bid.
Yeah.
And it's called the winner's curse. So like whoever wins just overpaid.
Well, it's like
that's the
negotiating.
theory.
It's
Yeah.
if you make your offer and they take your first offer and you go,
You know you just
Man,
got
I
taken.
should have went less because they took my first one, which means I didn't make the right offer.
Right.
But it's not always the case. It could be as long as you made a good offer for yourself and you feel like it was a good offer. Like if there's a stock trading for $50 a share and you pay $150, but you really truly feel
Yep.
like it's going to hit $200, getting it and making a smaller profit is, might be better than getting it and or not getting it and making no profit.
Well, one of the things you guys are going to get into next week is behavioral finance. And there are two schools of thought in finance. One is the traditional finance, and then there's behavioral finance. And traditional finance says that your personality and all your emotions have nothing to do with the price. The price is the price. It's worth what it's worth. That's traditional finance. So we call that, that's rational. So rational investors would always maximize return and minimize risk, period. And then there's this whole other field of finance called behavioral finance that says people sometimes make investment decisions based on other factors. And those other factors could be things like when you own something, it suddenly takes on more value to you. It didn't change its value, but to you it's now more valuable. There's an endowment effect. Or people have a tendency to hang on to their losers and sell their winners too fast. They're waiting for the loser to come back.
Making its comeback.
So it's coming back. But a rational investor would just say, what's it worth? That it's
Cut your
equal.
loss.
It should be the same, whether it's up or down. It's the same. So that's what your assignment is in this coming week, is looking at some of these behavioral biases. But those are two different schools of thought, and they don't always connect. There's people who are very strong on the traditional, and then there's others who are very, very strong on the behavioral.
That was one thing I remember how we, when we were at Toys for Tots, how I mentioned my professor, Pamela Peters.
Yes.
That was one thing that always got on her skin, too, was the term overpriced. Like, it was sold in the market, and it was purchased. So how then does it become overpriced?
Right.
That I was always like, if it's an efficient market and then someone sold it and someone else then in turn bought it at that price.
Then that's the price.
Exactly.
It's
they're
the
bringing
market.
PE and everything else kind of just like,
Yeah. Well, that same goes with real estate. We have
Depends on
come
the
to an
value it is
agreement.
to you at the time.
We've bought the house. I've agreed to buy it from you. You've agreed to sell it to me. We've just said the market. And then we bring an appraiser in who says, oh, it's not worth that. Well, but we've already said what it's worth because I'm willing to pay that. So it's the same idea. They're saying, no, it's overpriced. Okay, so this is the secondary market. These are the mechanisms that are out there. I have a few minutes. Let me talk about, this is a topic that I think you should kind of be familiar with, even though it's not really listed on any of your, it's just listed on the agenda I posted just before coming to class. And this is the concept of an index. And the reason I just want to talk a little bit about stock market indexes is because every time you open up CNBC, they talk about the market going up and the market falling and the market crashing by 7 points or whatever, like little teeny amount it is, because they need news. So I just want to talk about what is an index, how are they constructed, and what makes a good index. Right? So that's what I want to just finish with. So an index. This is really just a statistic. It's a number that captures the percent change of a market.
Thank you very much.
I'm sorry?
Make sure to talk to somebody else.
Oh, okay. So we have things like the consumer price index, right? So CPI, that just tells us what happened to a basket of goods. It gives us a sense of inflation. It's just a statistic, right? You don't actually buy or sell it. It's just a number. So we have statistics in the stock markets that give us a sense of whether markets have generally gone up or down. So examples would be the S&P 500 or the Dow Jones Industrial Average. Right? And then lots and lots more. There's one in London, there's one in Germany, and so on. So these are just these are just statistics that tell us whether markets have gone up or markets have gone down. They're used really for two purposes. One is for performance. And another one is benchmarking. And this is what we're used to. We use the S&P 500 to tell us whether or not the market in the U.S. has gone up. Did it go up today? Well, the S&P 500's up, so yeah, it's up. Or down. What was it today? Down. Benchmarking is a little bit more new. That gives us a kind of a list of stocks if we wanted to construct our own portfolio based on it. So a benchmark gives us a way of constructing our own real portfolio based on the constituents or the components of this index. And so many do. There will be many, many funds or investments out there that mirror an index. So there's the Vanguard 500. It mirrors the S&P 500. Practically every mutual fund company out there has something that mirrors the S&P 500. It's not the S&P 500. The S&P 500 itself is just a number. It's just a statistic. But others have created portfolios that match it, that mirror it. So that's what we use these indexes for. Now, when you put together your statistic, you have lots of choices on how you compile this number. The first one is if it's price weighted. And that's like the Dow Jones. The Dow Jones is a price-weighted index. And so all you do is you take all the prices of everything and you divide those, you add them up and you divide by the number of stocks that you have. Right? So you'd have, the first price plus the second price plus the third price. There's your index. One's trading at 50, one's trading at 10, one's trading at 100. Add them all up, divide by. Now, the Dow Jones is a price-weighted index. Now, why on earth would we have a Dow Jones that's, what is the Dow Jones right now? It's like $16,000. So there's no way that you can add anything up in the U.S. and divide by, how many stocks is it, 30? That you can, I don't know what's, sorry.
Texting or
Oh, it's Crystal.
Chatting.
Oh, okay. I guess I'll just pretend like that's not happening. I can ignore things. So anyway, so we've got this, a little funny, this price-weighted index. And the Dow Jones is a sum of 30 stocks divided by 30. But then what's happened over time is stocks have split and stocks have been replaced. And all these things have happened, but you don't want to make those events look like the market went down. So if they took out a $100 stock and they replaced it with a $10 stock, it would look like the market just fell out of bed, but it didn't. So we adjust the denominator to make it look like nothing happened. And that denominator has been adjusted and adjusted and adjusted over time, that the number today is up to this huge, huge number, right? Price-weighted index. There's also what's called a cap-weighted index, or market value-weighted index. And so here we let each company represent a portion of the index based on how big the company is. Here, whichever stock had the highest price carried the biggest weight. So if we had a $100 share and a $10 share, then the $100 stock carries most of the index. It carries the weight. But yet the price of a stock doesn't matter. It's the price of the stock and how many shares are out there altogether. That's what matters. That's the size of a company. So you could have one share of $100, or you could have 10 shares of $50. Your $50 stock is a bigger company, right? So cap weighted, here we would take all of the prices and we would multiply them by the number of shares. And then we would add them all up, all of them, right? Across whatever market we were in. This would be a cap weighted or value, not value, market value weighted index. So the Dow Jones is price weighted and the S&P 500 is cap or value weighted. So this is a synonym. And then there are other weighting schemes. We could do a weighting scheme where we say, what if I invested $100 in every stock? So the $100 stock gets 1 share. The $50 stock gets 2 shares, right? We can do that. That would be called an equally weighted, but we won't worry about that. So we can weight this however which way we want. And it kind of matters when somebody tells you the market went down for you to figure out which of those indexes are they talking about. Because the Dow Jones only has 30 stocks in it, and they're price weighted. So the biggest priced stock moves the market the most. S&P 500 has 500 stocks in it, and the largest company moves the market the most. So now it matters when someone says that the market's down. It depends on which statistic we're looking at. So this is what indexes tell us. A good index has 2 characteristics to it. One is it has to be tradable. And 2, it has to be representative. It has to be tradable, it has to be representative. So if I wanted to replicate an index, and it's got 6,000 stocks in it, it's going to be hard for me to create a portfolio that matches it. It's low on the tradability scale, because it would take an awful lot of transactions. I would be calling every broker on the planet just so I could create a portfolio that mimics it. So it's difficult to actually trade that basket. Right? It's low in terms of tradability. So what I might do instead is pick like the top 100 that captures for the most part. I might do that. That would be a way to do it. You know, I can kind of get around this tradability issue. So if it's tradable, it's easy to trade all the components. And by all, I mean all. So some indexes are very, well, let me first define representative, and you can see the trade-off. Representative means that it captures everything that we know about the market. So all the small companies and the mid-sized companies and the large companies are represented in this. So if I say that I want an index that captures the U.S. market, that I've actually truly captured the U.S. market and I haven't just taken kind of a sliver of the market. This index is representative of the real market. Right? So it captures or it represents all the different risk factors available. High PE and low PE, large stocks, small stocks, whatever. Right? All the different things that we can tell about these stocks. So the trade-off for many indexes is an index might be tradable because it doesn't have that many components, but then that means it's less likely to really represent the market. And if an index really represents the market, it's going to be awfully hard to get your hands on everything in it, so it becomes a little bit less tradable. Does that make some sense? So there's a bit of a trade-off between tradability and representativeness. And as a portfolio manager, you have lots and lots and lots of choices of indexes. So you might pick the one that kind of captures the best of what it is that you are trying to do. So if you are a portfolio manager and you're really good at picking out small company stocks, you might try to find a small cap index rather than like the S&P 500, which is the other, like everything. Or if you're really good at investing in emerging markets, you really don't want a U.S. index at all. You want an emerging market index. So you want something that's representative, but you want something that you could actually get your hands on the contents to make it tradable. So that's really all I needed to say about indexes. I feel like I should not let you out of a class that's dealing with investing when this is all they talk about on the news every day and never have touched this topic. So any questions? All right. With that, I'll let you go. It's 7:20. I will see you on Monday, and I look forward to reading your assignments. Thanks.
One question, with in the syllabus you had for this week, chapter 4 and then 28.
So that'll get captured in your assignment that's related to 4 and 28.
And then there's also 12.
Yeah, so I'll talk about that next time. So it'll be,
In response.
I'll deal with the topics that are related to behavioral finance and managing portfolios and all that next time.
But were there any